Hi, in this video we will get started on valuation and the different valuation methods that can be used to find the intrinsic value of a stock. So if you're interested, make sure to stick around as we are starting right now. An investor wishing to invest in a business for the long term should be immune to short-term noises in stock prices and should be able to focus on the underlying business. Over the long term, stock prices of fundamentally strong companies tend to appreciate, thereby creating wealth for its investors. The return on investment is highly dependent on the valuation method used. Different types of investors value companies in different ways. A value investor does not value companies the same way as a growth investor. Different valuation methodologies are used because all valuations are based on historical data and most valuation methods use forecasted data. This may lead to incorrect target prices. Using multiple valuation methods and taking the average of the different methods helps in normalizing the error. Before starting valuation, you need to identify what kind of an investor you are. Are you inclined to growth investing or value investing? Or do you want to have a piece of both? Investors who like growth and are ready to pay a higher price are considered growth investors, while investors who like cheap companies that are not growing quickly are considered value investors. Growth companies are focused on growing earnings aggressively and they reinvest their gains to grow the business rapidly. Eventually, all growth stocks become value stocks, and Microsoft is one such example. Now, let's talk about value investors and growth investors in detail. Value investors like cheap stocks with low growth, while growth investors love expensive stocks with higher growth. Value investors love companies with a low price to earnings ratio, meaning how many dollars are you going to pay for every $1 in earnings. Growth investors like to invest in companies with a high price to earnings ratio. We will talk about price to earnings ratio in detail when we get to valuation methodologies. For value investors, cash is king and they love companies with a ton of cash flow, while growth investors love companies that reinvest their cash to grow even faster. That being said, growth and value investors do not use the same valuation methods to determine the intrinsic value of a stock. Personally, I use 3 different valuation methods to determine the value of a stock: discounted cash flow method, price to revenue valuation method, and price to earnings valuation method. I'll be talking through each method in detail with examples on my upcoming videos, so stay tuned by subscribing to my channel. Until we see next time, thanks for watching. Bye.